All right, we are live. What's up, Sam? How you doing, brother?
I'm good, brother. How are you?
I'm living the dream, man. I appreciate you taking an hour out of your day to come chat with me. For anybody who's joining us or watches this on replay, Sam Parker, owner operator of MyCreditGuy.com, the best credit guy in the business if you ask just about anybody in mortgage. So happy to have you on and happy to just chat credit, because credit is super important, especially when someone's trying to do the biggest transaction of their life for mortgage. And so I think for the purposes of this, we'll do mortgage specific. Do you do credit repair for people outside of mortgage?
We do, but the thing is, from our standpoint, we want a serious client because we have so many people that are dead serious about getting qualified for a home loan that we don't want, like, there's law firms out there, right, that compete in our space, and they promote, and most credit repair companies honestly promote to somebody's weaknesses, in my opinion. No, they say, oh, we'll get everything removed. That shouldn't be on there. You didn't know about that. And that's just not true, right? And so anyway, we do provide credit repair services to people who are serious about credit repair, but they have to come in with the right mentality. Otherwise, they're getting in the way of our clients. We got to get back to the closing table.
Right. Cool. Yeah. And I've seen your work in action where, you guys get in there and are super proactive and have a timeline and a game plan. It's like, hey, listen, you want to buy a house, you're serious about buying a house. Here's our plan. Here's what you got to do. Here's what we're going to do. Maybe walk us through that, because I'd be interested to hear it from you again. Somebody comes to me and we have a conversation, and maybe I pull their credit and they have a mid score of 595. And I tell them, what if you get to 640, even at 595, you can get a home loan. But if somebody comes to me with that score, I'm going to be honest with them and say, listen, at 640, the terms on a mortgage are going to be so much better. Why don't you get with my buddy Sam and his team? He can help you out. What does the process look like for them as soon as I send them over to you and you guys contact them?
Yeah, great question. So we start with a detailed review. We're going to figure out what the client disagrees with and why. Now, sometimes the client can describe that to us and we can kind of lay out a game plan for them. Most times we're going to want to see a credit report. If they don't have one, we can help them pull one. And we're just going to go through that with them and figure out what they disagree with and why. Sometimes it's a tough conversation, Matt, where I say, I understand you're upset about that, but legally, that's yours. It's not going anywhere. You think about like a divorce or a bankruptcy, something like that, where it's ugly, it's not on there, and there's a lot of misconceptions about it, but it's there. So sometimes I have to head them off at the pass and say, hey, listen, unfortunately, we just got to work through this. But a lot of the times I'm going to be able to see the items that they disagree with. I'm going to hear why they disagree with it. And then I'm going to be able to go after those items. And when I say I mean we, My Credit Guy, is a staff of about 70 people. And we're going to be able to go after the inaccuracies on their items for violations of the Fair Credit Reporting Act, the Fair Debt Collection Practices Act, things like that, where things are truly inaccurate, where most credit repair companies are just saying, this isn't mine, take it off the credit report, just a blanket statement. So we're going to get as many of the items as we can removed or updated, anything that's inaccurate, outdated, duplicated. Where we really switch gears, though, and start to pull away from our competition, Matt, is what happens next, where most credit repair companies are just going to dispute over and over again. And that means that 6 to 9 months later, both you and the client are like, hey, where's credit? Can we move forward? And it's probably where it was 6 months ago, right? Because they're just doing the same thing over and over again. What we're going to do at that point is switch gears and help the client negotiate those debts that are legally validated by calling that creditor up or sending them correspondence and doing settlements, doing pay for deletions, helping the clients make good on these debts that were legally validated, but then also do so in a way that's going to increase the credit scores and make them more mortgage worthy, because that's a fine line to walk. There's a lot of things that you do thinking that you're shaping up credit, and in reality, you're spending money to drop your credit scores. That's one of the forks in the road, Matt. And when we get to that point, so after investigations, we're sitting there and saying, listen, client, you had 8 negative items. We got 5 of them deleted, 3 of them remain. And let's say that the client adamantly disagrees with one of those items. We're not going to make them settle anything, and we can't make a client pay anything they don't want to pay anyway, unfortunately. But what we would do at that point is we have FCRA, Fair Credit Reporting Act, and Fair Debt Collection Practices Act attorneys waiting in the wings. So if items are verified that legally shouldn't be, we will refer them over. Those attorneys will sue the credit bureaus or the creditor at no cost to the client. We'll get the outcome that we need to get, and the client will probably get some damages as well. And that attorney is paid by the offender, not the client. So So it's just kind of a sorting process. I describe our service as like water, right? Like it just flows. There's always somewhere for it to go. It never dead ends as long as the client's ready to go. So like I was saying, we go through, we get the inaccuracies removed. We help satisfy the debts either through settlements, pay for deletions, or sending them to an attorney. We give the client one dedicated credit coach that's assigned to them throughout the entire process, whose sole job is to educate them, make sure that they understand the next steps, the whys about credit, not just pay your credit card down, but why do we tell you to do that? How is it impacting your credit and your family on a daily, monthly, yearly basis because of credit? So we'll teach you about credit. We're going to help them establish new positive trade lines and really teach them how to use them. And when I say that, I usually mean credit cards, credit rebuilding credit cards, because credit's a game and you have to learn how to play by the rules of the game. You can't sit on the sidelines and choose which pieces you play by and which pieces you don't. If you don't have credit cards, you probably don't have a credit score. You have a low credit score. So we're going to make sure that all those pieces are filled in, they're educated, they're on a budget, that the inaccuracies are off their credit report, that the things that were legally validated are taken care of. And then what do you know, 3-4 months later, usually 5, 6 at the worst case, we're sending them back and saying, hey, Matt, listen, this client that started with a 590, I know that you needed a 640. How's a 682 sound? Because that's what we're sitting at right now.
Nice. Yep. Cool, man. That's a bunch of good info. And I'm taking notes over here. I got my remarkable notepad, because as you're talking, I'm thinking about past clients. I'm thinking about like questions that I've gotten in the past that are super common. And you touched on it. So it's a good kind of segue. Building credit. I'll get clients all the time that, the limited knowledge that I have, I know that you need a certain amount of trade lines to kind of, get this algorithm to think that you're responsible with credit. Because, without trade lines, you're not responsible. So maybe elaborate on, somebody who's only got one credit line and maybe their credit score is lacking just because they don't have enough credit. Speak to us about, opening new lines of credit and how that's going to help somebody.
Yeah. So it's hard. I have a tough time answering just one question because it's all
ties together.
It really is. So when you don't have enough positive trade lines, you're really impacting 10% of your credit score at minimum, which is the proper mix of credit. The proper mix of credit basically means that you have installment loans like an auto loan, a student loan, a mortgage, things like that, where the payment's kind of predetermined and the schedule set out, and the risk is really mitigated, meaning they've looked to make sure that you can handle this debt, right? So if you don't have that and you only have credit cards, or most people usually only have like an auto loan or a student loan and they don't have credit cards, then you're not acknowledging the proper mix of credit. So you're missing out on 10% of the credit score, but you're also kind of blocking yourself from other sections of the credit scoring algorithm, right? So if you don't have credit cards, then you're not really maximizing the 30% credit usage category of the scoring algorithm, which I just call the credit card section, because the credit scoring algorithm doesn't really penalize you for maxed out installment loans, because you think about, like, you get a car, right? You get a $20,000 car, you're getting a loan for $20,000, and the credit scoring algorithm understands you're not misusing that. Where if you go and you get a credit card and you max it out, you didn't need to go do that, right? That was an unexpected cost. And so if you only have one credit card, you don't have what's called a proper mix of credit. So you're either going to have very low scores that kind of stall out, usually in the low to maybe mid 600s, or you're going to have what's called a no score, where you're just not providing enough information to the credit bureaus or the credit scoring algorithm to generate that credit score. So when you go to pull, there's just nothing there. And most banks want to see 3 credit scores, and they're going to choose from the mid score.
Cool. I got to say what's up to a couple of people in the chat. I got my buddy Kyle Seagraves, Win the House You Love. I know
what's up, buddy?
a buddy of both of ours in there. Somebody in the comments too, I saw they got LASIK done, which is Kyle got his done. Kyle can now, when he talks, he's got such good vision, he could see people's credit scores when he talks to them face to face, because it looks like Mail Cold got their LASIK done too. So congrats to you, Mr. Mail Cold. This guy's a local guy to me in Sacramento, Mark McDonough. Howdy. Here we got a question for you. I have $6,500 in credit card debt at 0% interest. Should I pay this off before applying for a mortgage, or add this towards savings? The monthly is $110 a month.
So what I'm more concerned about, Mr. Cold, is the balance to limit ratio on those credit cards. Okay. If $6,500 is out of a $7,000 limit, I would want you to adjust those because your credit scores are going to go up significantly. So even though that's money being paid out at 0% interest, which now we're talking about opportunity cost, really, right? Well, $3,000 spent on that is going to save you tens of thousands, more than likely, with increased credit score, lack of private mortgage insurance, maybe bumping you up to qualifying for a conventional as opposed to an FHA if that's the proper fit for you. But I would need a little bit more information, but getting those credit scores increased is typically going to pay you back over and over and over again, not only on that mortgage interest rate, but really anything else. So
anything.
Yeah.
All right, Kyle. Thanks, brother. My kid is going to be so stoked about this. What is this called? It's gosh, when you go live and it's called Super Chat. Super Chat. So the kids, my kiddos that have their gaming channels they love watching on YouTube, Super Chat from Kyle for $20. I appreciate you, man. What are your thoughts on getting a loan with a lower credit score, maybe less than 640? Better to raise credit first, then buy, or raise credit, then refi? I guess this could be a question for both of us. You go first, and then I'll chime in.
I guess I would say it just depends on your situation. You know, if you can, and it's not just I really want it thing, I would like to see you spend the time to raise credit. But if you're saying, well, I need a year to raise credit and I can lock in an interest rate right now, but it's going to be a crummy 3.8 whatever percent. It's like, oh, you mean the lowest interest rates that really we've ever seen still? You know, I mean, I know it's dipped or ticked up a little bit, but it's just situational. But if you have the time and you can quickly improve credit, it's usually going to be worth it to do it. But then you just got to look at opportunity cost. Matt, what are your thoughts?
Yeah, I mean, I think the same, where generally when I talk to somebody, I'm trying to not come across as a salesman. And I tell people March of 2021, there's houses for sale. April 2021, next year, the year after that, there's always going to be houses for sale, right? So you should never have someone kind of telling you like, you got to buy now, the ship's going to sail, something's going to happen. And so in this scenario, if somebody came to me with 595, I would probably show them both. And I'd say, listen, if you've got your mom's neighbor who's going to sell you a house for $50,000 below market and you can get a great deal on it, then maybe we figure out a way to get you an FHA loan, improve your credit, refinance you down the road. But if it's just a matter of, wanting to buy, a market value house, then I would prefer that somebody waits, unless there's a great opportunity now where it's like, hey, we got to do this because we're going to get it a lot cheaper than we think we can get it 6 months or a year from now. So I think we're probably on the same page there. Is it's worth it to repair your credit and get to a lot better looking loan.
It really is.
All right. Mark says, what happens if a person is looking for a new home and is getting pre-approved with a bunch of lenders? Oh, this is an amazing question, Mark, because I get this question so often, and I probably shouldn't say this on a live, but I kind of guess when people ask me this question, because I think that I've heard something about within a 30-day period, but you're the credit expert. So tell us, Sam, somebody gets pulled from me, they get pulled from the builder, they get pulled from another direct lender in a matter of 14 days, and they think it's going to hurt their credit.
Yeah, the good answer is it's not. That first pull probably cost them anywhere from like 1 to 5 points, but then every pull after that, and there's arguments in the credit world whether you get a 15-day window or a 45. Just from my eyeballs in about 20 years of experience, it's 45, or at least that's my strong opinion, that you get a 45-day window, especially in mortgage, to have credit pulled. Now, I'm not saying you should do that. You should find Matt and his team and just stick with that one lender you trust. But hypothetically, if you had already been to 2 other lenders, had them pull, had that builder pull, then had Matt pull, you're not going to see a negative or adverse impact to credit. And that's actually one of the common misconceptions, Matt, because we'll have somebody come in and they'll be like, oh my God, my credit's just getting killed by these inquiries. And I'll go, I mean, you don't think it's the collections or the late pay, and it's
I
just
missed
like,
4 mortgage payments. I got 6 things in collection, but these dang mortgage pulls are just killing me.
yeah, it's because here's what it is, okay? Anybody that's watching, let's just be serious. Let's get into your psychology. It's the one place where you can say, that's their fault. That's not my fault. That's the finance guy at the car place. That's not my fault. And it's like, look, I'm not saying anything's your fault, not your fault. I'm just saying the majority of the things that are on your credit report are because you said, please put these on my credit report in one way or another. And so we just have to deal with them as they are, not as, we'd like to believe off of reading a Facebook thread from credit advice from somebody's brother-in-law.
Everybody in the first time buyers section of Facebook knows everything about buying and credit. So my follow-up question to that is, when somebody tells me, hey, listen, I want to get pre-approved, I want to know how much I qualify for, but I don't want to pull my credit, you're saying 1 to 5 points for a credit pull is probably how much it's going to affect them.
Yeah. And I'm also saying, not the mortgage person right here. I'm saying, listen, you want to borrow hundreds of thousands of dollars that aren't yours. They need to see what your credit looks like right now. Like it's nothing against you. They don't know you. They got to look at your numbers and see who you are financially to see what your resume looks like. What have you done in the past? How did you treat the opportunities that have been put in front of you? That's the bottom line. They got to look at it. So
I can just tell you over the phone, I'm good for it. And that should be enough. Send me the pre-approval letter. I'm ready.
It's some of the, everybody, not everybody, a lot of people come into credit repair emotionally charged, and it's a letdown to them when we have to say, like, look, unfortunately the emotional piece of it, the backstory, because they'll say, sometimes you'll get people that say, like, I want you to let them know that I'm a good person. And I'm like, I believe you, you're a great person. It's just that Equifax doesn't care. Right. And so it's all just behavior, and
Right.
and there's no explanation needed. Just, did you pay it or didn't? And if you didn't, we got to work through it.
Right. Yeah. I mean, I get the same thing with mortgage guidelines where it's like, listen, I've got mortgage guidelines that I've got to follow because Fannie and Freddie make the rules.
Yep.
And, a lot of times I get emotional with the client because I'm like, man, this is a good person, right? They've had a bankruptcy, they've had a foreclosure, they went through a divorce, and they've got credit challenges, not because they're not a good person, but, the fact is, on your side with credit, on my side with mortgage, we got to play by the rules. And luckily, you got pros like Sam in the credit space that can help you play by those rules, beat this game of credit. And I think it's more important than people give it credit for, because like you said, 640 to 680 to 720, people don't realize, like, that's tens of thousands of dollars. And that's just your mortgage. Then you go get an auto loan and you get 4% or 3% instead of 12. Geez, dude, I've seen some auto loans where I'm like, this guy got into a 24% auto loan.
Well, and you can always, Matt, like, I can almost always look back at a credit report and be like, this is where your financial life started to unravel. I can see that auto loan in 2012 with the amount of the auto loan, or the car was $22,000, but then why are your pay? I can see that the payments were $780. Like, well, oh my God, you got a 22% interest, but then the client will say, yeah, but then that thing broke down, so I didn't pay it. It's like, right, because instead of spending a little money and time getting your credit fixed, you went to the first dealership. The dealership told you no, but
we'll finance anybody.
Right. Well, or they said no, and they go, you know what? Then there's a place down the road I can go to. It says buy here, pay here. They go there. They get the car because they needed the car that day, had to have the car that day, had their mind on the car that day, right? And so they get the car, and then it's a lemon, which is why it's at this place right now. And then it breaks down. I mean, this is the play that these guys do. They like, I've literally had these places approach me before and be like, here's the beauty of it. We repo, and then the number is ridiculous, Matt, but they sell these cars. They're not good cars. They get high interest rates. The people don't make the payments. They repo them, and then they sell that same car at a high interest rate, and they just keep it going. And then that domino right there, then the next time that client goes and tries to get something, they have a repo, or they have a collection, they have something like that on their credit, and then they're falling into the same trap on every single thing that they do from then on. So
that's too bad. We can help some of them. Mail Cold has a question. 6,500, 12,000 limit, 2 car loans at 500 each, no other debt. I'm in the mid 750s and my wife is 790ish.
You're just bragging right now, man.
Yeah.
You're bragging.
The comment below was less than 5% utilization, which is probably a good reason for that good score, right?
I would leave mail cold. You don't need to. It sounds like you got some nice high limits. I want you to keep those credit cards between 5 and 10%. Just hover right there. So if you're already there, you're doing things great. It sounds like more than likely, don't close those cars out either. Drag your feet on that. Like a lot of people will get really proactive, especially this time of year with tax returns, and they'll go, you know what, I'm going to pay those 2 cars off. If you're about to finance on a home, make your minimum payments and try to get that financing through before those 2 auto loans get paid off, because more than likely that's anywhere from 3 to 5 years of pay history that you're about to pay off, close an account, and then you're going to see your scores drop. Don't shoot the messenger, but you're going to see your scores drop when you close out that installment loan, because, and with your credit the way it is right now, mail cold, what you're probably missing out on is just a nice long pay history. Meaning like that one account that's been open for like 15 years. Once you get that, you're going to pop up into those 800s and be good to go there. So it sounds like you're doing everything right.
Awesome. Check this out. This is my family. This is my beautiful wife and my boys with a $25 super chat. Deluncules with great credit qualify. Well, I got a 12-year-old and an 8-year-old. They got to work on their credit. My wife brags because her credit's better than mine, because I loaded up a bunch of stuff, and like most guys, I was dumb in my 20s. But I should be mid 7s now. She's like 790. So thank you guys for that super chat. See, you're learning new stuff all the time. Now I know what a super chat is.
I'm checking it out.
It's cool, dude. Going live on YouTube. You become pretty cool to your 12-year-old kiddo once you start going live on YouTube.
I know, they watch YouTube all the time, and I'm like, I'm on YouTube, and they're like, oh.
How old are your kiddos?
6 and 8.
Okay, yeah.
I'm not an imposter, so I'm not cool right now.
Oh yeah, that's a good game. What else is there on YouTube? You watch Mr. Beast and all the.
They do. I walk out to people just constantly going like, "Oh no, what's this? Oh, I gotta come over here, Bill. Oh no, my cat's caught." And like, I'm just like, "What are these grown people doing?" But they love it, and it's good, clean fun. So.
Oh yeah. I mean, there's some good stuff on YouTube for kids, like Dude Perfect. Have you seen that? You got to check out Dude Perfect. They do like basketball trick shots and like basically like the most fun you've ever had with your college buddies. These guys get to do it like every single day.
That's awesome. My daughter, I will say, when my daughter was 4, almost 5, she got onto this YouTube channel called Number Blocks, and she literally taught herself multiplication. Like one day I was messing with her and I was like, "What's 3 times 4?" And like, she just got quiet for a little while. She's like, 12, like out of nowhere. I was like, "What's 12?" And she's like, 3 times 4. And I was like, "What just happened? Like, how do you know that?" And like, I hit her with a couple more, and it was like, I'll come out. It's like YouTube. I love it, and I hate it.
I'm telling you, like, you think about it, like YouTube University, the kids can learn endless stuff, right? And like my kiddos watch engineering channels. They watch like all kinds of cool stuff. My wife makes me learn how to fix a dryer, fix a refrigerator, all that with YouTube. Because all you got to do is type in whatever you want to learn, and you can learn it.
Exactly what you want, like to the model, to the year, to the like. I one time I was like, I've lost a little screw in my middle console in a 2018 Tundra, and like I was like, I'm desperate, and it popped up, and it was like, let me guess, you're having a problem buying this replacement part, and I was like, yeah. So yeah.
Oh man, we're off track. Let's talk about some credit. Is it better to have a small balance on a credit card, or is a zero balance just the same?
Small balance. You want to show that nice steady pay history. You want to show the behavior is there, the mentality of I don't need it, I'm not going to use it. It doesn't work when it's, again, somebody else's game. You want to borrow hundreds of thousands of dollars from somebody, and they're telling you, not very well a lot of the times, but they're telling you, well, in order to do this at the lowest interest rate, here are the things that you would need to do. And it doesn't say get a credit card, keep it in your wallet, never use it. It says, show us that you can go out, spend some money, be risky with it, and keep your balance nice and low and make your payment every month. And then we'll give you a higher credit score. So that's what you got to do. Okay.
Yeah. And I've heard different stuff. If you've got $1,000 limit, are you trying to keep it between 5 and 10%, between 50 and $100? Is that probably a sweet spot?
Yeah, that's where I hover. I mean, if I'm being intentional about my credit, if I'm gearing up for a purchase, I'll start revving up, start using those cards strategically a couple months beforehand, keeping them between 5 and 10%. And then that way when credit's pulled, I'm same as, male cold there. I'm in my upper 700s, and I just need to get a little bit older and have some of my accounts get a little bit older, and then I'll be up in the eights.
Right. Yeah. It's crazy how that works too. I remember a time where I pulled credit on myself and I was 720-ish. And I was like, I shouldn't be, it's come down 30 or 40 points. Why? Then I looked at it and I had all these zero balances where I hadn't,
Yep.
there was no activity. And so the credit algorithm looks at it and says, one, we want you to have, debt utilization low, but two, we want you to be active. We want to see that you can handle credit and manage it.
Yeah, I use analogies. Some of them are weird, right? But like I talk about credit like a resume, and I also think of credit as like when my girls, God forbid the day this happens, but when they bring a guy back, right? I'm gonna want to know. Actually, weirdly enough for him, like how long have you dated other girls? What do their dads say about you? I'm gonna want to know these things, and and when the guy goes, you know what, I'll be good to your daughter, but only because I've never dated anybody else and I'm going to stay in my house. I'm gonna be like, no, like I want to know how you've treated other people in the past, right? And that's the same with credit. It's the same with resumes. It's the same with so many things, is that the whole point of credit is being able to fast forward a relationship and look at how you've treated others so that you can make a decision. Otherwise, you would have to show these creditors for years that you were worthy before they're going to lend you hundreds of thousands. So you're just trying to show them glimpses of how you've treated people in the past.
Right. Yeah. And if there's no credit history, this is something that I really want to talk to you about, because I like some stuff that Dave Ramsey does, and he does some stuff good. But when it comes to advice on mortgage, I disagree with him on this one. And so I literally came across something today that was, another one of his things that he advises people: pay off all your credit card debt. Your credit score will disappear, but don't worry, you could still get a mortgage. I know what I know about, one, how hard those mortgages are to get, and two, what the crappy terms are. But, what do you have to say about the advice that somebody wants to just get rid of their credit score altogether?
Well, I would ask, what, does the mortgage company that he gets paid by, do they offer a lot of no credit score loans? Because I don't think they do. The last time I checked, they also had credit minimums. So the offer kind of contradicts also some business relationships that he has. So I don't think it's great advice, because in this day and age, in 2021, why not play the credit game that you have to play in order to have great credit scores? Because if you try to sit on the sidelines and cut up your credit cards, the majority of the time when you go for financing, you are going to get told no. They don't want a situation where somebody's not displaying a responsible credit usage, especially not recently. They want to see, the credit scoring algorithm is designed specifically to tell, what have you been doing? How likely are you to default on credit in the next 2 years? And so it's looking at your previous 2 years with a microscope and saying, like, who are you? Should I lend you money? And if the answer to who are you is, I stay in a shell in my house, I don't go out, right? Like they're not who you, or you are not who they want. They want somebody that shows that responsible usage. Another analogy I give is like, the credit scoring algorithm is like scouts in a stand, right? And to only pay a little, like a student loan payment or a car payment or something like that, is like taking a snap. Quarterback tryouts. Sorry.
Tryouts. Football reference. All right.
Quarterback tryouts, football reference. Okay. So it's like taking a snap, dropping back 3 steps, and then just doing a nice little pass over the middle with nobody rushing you, right? And you're like, look at that. Look, I can handle it. And they're like, no way, dude. We want to see people running at you. We want to see you out of the pocket. We want to see you scramble. We want to see all these different skill sets when it comes to finances that you're not displaying to us by simply not using credit, right? And so that's what it is it's not just that they want to see you be clean. They don't just want to see this quarterback not be tackled. They want to see all these different skill sets that mean that on game day, or when you get a mortgage, that you're going to be able to handle it.
How do you handle the pressure of this big old mortgage payment on your head? Yeah. Yep. And it's funny, because I've had people reach out to me and they're great, and they followed this Dave Ramsey plan. But then when they come to me, sure, I've got lenders who will do financing for somebody who has no credit score. They'll manually underwrite it, just like Dave Ramsey preaches.
Yep.
And guess what? You get to use the 580 credit score, because you have no score to go off. So they're just going to manually underwrite you and give you very bad terms. And
Right.
it's crazy because like your risk level, if you have $1,000 credit card with $100 on it, that even if you didn't pay it off and you paid $4 in interest, you pay 2% extra on your rate. You're paying an extra $6,000 or $8,000 per year.
Right.
Keep the credit lines open, keep a credit score. Like you said, you got to play the game, or you just do everything in cash, no credit score, and you never finance anything ever again, which is not something I would recommend, but that's kind of the alternative.
Yeah, I mean, here's the bottom line with, in my opinion, with a lot of what's being taught there, it's maybe not how to be in debt, but it's definitely not how to build wealth either. And that's what even if you strive to build wealth in this lifetime, there's a good chance that you're not going to end up near as far as where you want to be. But if you're only trying to stay, just above broke by putting money in envelopes and stuff like that, I think it's sooner or later you got to take the training wheels off, right? Or maybe not. I guess maybe not all people.
Yeah, I mean, I guess it works for some people.
I know. It's just
in the mortgage world, my advice is let's manage your credit. Let's get you into a mortgage with a good credit score, because more than it affects you on that car loan or other types of debt that you're taking out, like it can be tens of thousands of dollars. Mail Cold had a question here about, is it better to make a payment in full before the closing date? Okay, to close a statement with a balance than pay it off in full?
That's a great question too. So that kind of brings up another point. So when credit is reported, right, you have a couple different dates. So you have the statement closing date, which is usually mid-month, somewhere between the 15th and the 20th. That is when the credit cards are going to say, this is the information that we have that we are reporting to the credit bureaus for next month, right? So like right now, March, your March balance very soon in the next week is going to be sent into the credit bureaus, and that's what they're going to report for this next month, even though there's 15 days left, right, in a lot of cases. So you have to make sure that the reporting date, or the statement date, excuse me, and that is paid before your due date, because your due date is usually after the statement date, or the reporting date, excuse me, that would update your credit card balance. So let's say that your payment is due on the 25th of the month or the 29th of the month, right? Well, if I paid something off on the 23rd of the month, then I'm rocking that balance of being, over 50% or maybe maxed out until the next organic update, which now you could be looking at 40 days before you're able to truly get a fresh look at your credit. So, it's not always set in stone that that's how long it's going to take, but you definitely run the risk if you're waiting. Definitely if you're waiting until the end of the month to pay your payment off, you're probably not going to see that update, 6 days later, in the first week of March, April. So,
right. Yeah. So that's a cool teachable moment for me, because I get that question a lot. Is there any way to know when that reporting date is? Is every credit card company going to be different? Because I'll tell you what the question is when it comes to me, Sam, is it's, talk to somebody, looking to get pre-approved. Great. And, hey, I just got my tax refund and I've got my down payment set aside, but I took $4,500 for my tax refund and I paid all my cards really low. So my credit's going to improve, but it's March 15th and they just paid all that stuff on the 6th. When would they expect it? Or is there any way for them to know when each individual card is going to report?
So you can call the card company and they'll tell you, like, you don't really have to chase for it. Just say, hey, when's the statement date? When do you guys report to the credit bureaus? And they'll tell you. You can Google a lot of it. Just Google specifically what the card is, and it should give you a lot of them. Probably 80% you can find online. But that phone call, just call them up, say, when do you report? When I want to make sure that I get my payment in on time. If that person paid something off on the 6th, then the worst case scenario is that they're waiting until the 8th of the next month. The 8th is kind of a magic day in credit. It's just when you can almost guarantee that everything has been updated from the previous cycle. So we're usually telling people, if possible, to wait to pull on or after the 8th of the month. I mean, there's been times, and not just times, I mean, very often, where we have somebody jump the gun, pull on like the 5th of the month. And then we go, no, there's a reason for this. And they pull on the 8th and they're like, well, there are those points that you said were going to be there. So, just
Cool.
get that number, put it in your calendar. And the other thing is, to protect yourself from credit these days, Matt, put every single thing on auto pay. Every single thing should be on auto pay these days, at least minimums. And then you can set up the exact date that you want it to pay. So you can be very strategic about it.
Right. Yeah, that's a good idea. That was worth the price of admission for me. Thanks, brother. The 8th. I'd never heard that before, but it's really good. I've got some notes from I sent out something to my database and got some credit questions. So I'm just gonna fire them at you.
Let's go.
This is something that comes up quite a bit too, especially in mortgage when someone's thinking about buying. So every point counts, and they've got collections that are old. 2014, where Comcast, and they may or may not dispute it, but is it better for them to leave that alone, or if they owe Comcast 179 from they moved out of an apartment and it's a disputed like internet bill or something, should they be paying off collections or just leaving it alone?
It really just depends. Let me get a look at credit. I can always tell you in 2 minutes what to do, but I would have to. There's a couple different ways. Let me walk you through it. Okay. So if you pay that collection off, you're going to update the date of last activity on a really old account to today's date. That is going to crush the credit scores. Okay. Plus, more than likely at 7 years old, if it's from 2014, it's past the statute of limitations anyway for collection. And it's honestly coming up on being past the statute of limitations for reporting. So let's make one a little bit sooner. Let's do hypothetically a collection from 4 years ago or 5 years ago. You might even be in between these two different statutes of limitation where they can't legally bug you to collect on it anymore, but they have another 3 years before it's going to drop off the credit report. Like in California, right? You guys have a super quick statute of limitations for collections on most debt. It's like 4 years, but the federal statute of limitations for reporting the credit, 7 years. So you would have to make that strategic decision of, does this thing need to be paid? Now, if you can get around it, let's say that there's a 5-year-old collection and you have one credit card that's over 50% of the limit, and we can pay that thing down, get your 40 points. You do not need to pay that collection off. Like, there's nothing that says you've got to pay it off unless the underwriter does, and they're probably not going to say that. So in that case, I would leave it alone. In another case, I just had one of my buddies text me that said credit score came back at 773, baby. And it was because the guy had a 760, one medical collection from a kid that was in college, I believe, hit credit. And that one medical collection took him down like 80 points because credit is so fragile the higher it gets. So there are some situations where it's like, well, we got to take care of this thing. No matter how old or new it is, we got to just go straight at it, go through it, not mess with it. And so in those cases, Matt, we would do what's called a pay for deletion, where we would negotiate, listen, the only way the client's going to pay this is if you agree to delete it from the credit report. And if we're really having a good day, we can get a settlement for deletion where it's like, look, client owes you $500 from 5 years back. We're not having them pay it to you. How about $200 and you go away? And I mean, it's a little bit more formal of a conversation than that, but that's
$200 and you go away. What do you say, bro?
Get out of here. Get out of here. Yeah.
And so in that case where it's like pay for deletion, is it automatically off and then credits, up next month, or does it take time to kind of sort itself out?
It can take up to 60 days. Sometimes they'll quote up to 90 days. It doesn't take that long. If they did what they said they were going to, we usually see it pop off credit within 30 days. But we also see probably 40% of the time that they say it, we have it in writing, and then they don't follow through and do what they need to on their end. So we'll always send a round of disputes right behind it, just because that way, when and if they fall through, we have that safety net. We're getting a deletion anyway.
Cool. All right. Thank you, sir, for that. This is right behind, like, I don't want to get my credit pulled because it's going to get dings. When people say yes to credit pull, the second most common question in mortgage is, why is my credit different when you pull it than it is on Credit Karma? And literally, like yesterday, I had a client that was super upset. I felt bad because I was like, I'm sorry. It's just the way it is. They're 760 on Credit Karma, and then we pull it in 682.
Yeah. It's just because it's different scoring algorithms. It's like, go back to sports reference. Okay. It's like, we're watching the same football game. You're doing the same things, but on one scoreboard, you get 5 points for a touchdown. And on one scoreboard, you get 7. And on another scoreboard, you get 12, right? It's like, it's the same thing. It's the same behaviors, the same actions. They're just being scored differently. In credit, for the most part, there's two camps. There's FICO and there's Vantage. Vantage credit scores are designed for consumers, and that's what you're going to pull online, usually with like free whatever scores.com, creditkarma.com is Vantage. And so you're pulling on credit there, and you're just pulling from a different scoring system, a different scoring algorithm that's looking at enough things and tweaking it just enough differently that your scores are usually inflated a decent amount compared to the mortgage score. The mortgage score is obviously trying to see, are you going to behave well on this hundreds of thousands of dollars we're about to lend you? So it's definitely more stringent. There's more stricter criteria on it. And so because of that, that mortgage score is a little bit lower, also because it's FICO, right? It's a whole different company that's created the algorithm. And then even within FICO, there's technically hundreds of different score or models of the FICO scoring algorithm, dozens in use. And so that's just the credit score that a mortgage lender pulls, nobody else really can pull out there, right? It's just a one designed for one thing, a mortgage lender. But any mortgage lender that you had pull that credit today is going to be pulling the same information and the same scores. So you got to understand that the mortgage lender would love it. Matt would love it if he could use that higher credit score, get you through, wham, bam, thank you. Matt gets paid when he gets you into a house. So, that would sound amazing to him. But the big banks, at the end of the day, decide what algorithm the mortgage industry uses, and they've said this is the one that we feel protects us.
Right. Yeah. And it's, one algorithm for the car dealer, one algorithm for retail, Best Buy, one algorithm for us. So yeah, I get that quite a bit. And it's frustrating because I would imagine as a consumer, hey, look, this is what my Bank of America card says. This is what Credit Karma says. And they're all in the 7s. Why am I 682? And my only answer is kind of like the one you gave.
It's as good as an answer as we can do because it's the truth. But even once it's explained, people are like, yeah, that's as much bullshit as I thought it was. Okay.
Right. Yeah, they're like, all right, fine. And I mean, the only real comeback I have for that is like, listen, Credit Karma is not lending hundreds of thousands of dollars. They can tell you you're pretty, just like your mom does, but you're not going to win the beauty contest just because mom thinks you're pretty.
Well, and especially when you go onto a website, it tells you a credit score. And then based on that credit score, it makes you a credit card offer over here in the margin. And then when you apply for that credit card, it's pulling a stricter version of the credit score. So then you don't qualify for that credit card that score said you would have. Now they're offering you a card based on your real credit score. So they're kind of like funnels, Matt. A lot of them. They're if you're not paying for something, the product, then you are the product.
Yeah, that's definitely true. What's up, Al Bundy? Al Bundy's always on my lives, and I appreciate you for being here, Al. Should I be paying off my credit cards 2 or 3 times per month before and during the home buying process to keep my credit usage as low as possible?
There's kind of an urban myth out there right now that if you pay like Al saying 2 or 3 payments in a month, that it can really jump your credit score up. Really what that is doing is just making sure that your payments or that your balance is going to reflect a low balance at that reporting date or that cycle date of the credit cards. So you can just make one payment. You just got to make sure that it's paid down before your credit card reports. So by making 2 or 3 payments, what people are accidentally doing, they think that they're intentionally tricking the system by making 2 or 3 payments, but really what they're accidentally or the byproduct of making those 2 or 3 payments is that those balances are always staying pretty low. And that's where those points are coming from, not from the extra payments.
Right. Yeah. It's like the people online that are talking about all these hacks for paying off your mortgage in 7 years. And it's like, it's because you're making extra payments. That's why your mortgage is getting paid off quicker. Same thing here. It's like, if you paid $100 and your balance went down to 20, it's the same as if you paid 30, and 40 and your balance was 20.
Yes.
Makes sense to me, the math nerd. This is a random question because it just came up. What if I make a payment and my credit card balance goes negative? Does that affect anything?
No, you'll just get a
shows
credit.
Up kind of like a 0.
Yeah, well, you'll get a credit on the credit report. It's going to show 0, and then you'll have a credit on your credit card. So then it'll just be applied towards your next payment, typically.
Okay.
Or if you never use it again, then they'll eventually, like 6 months later, send you a check for $4.
I can't get no bonus points.
No bonus points.
No bonus points. All right, I got another question that came from my database about how does a mortgage late affect credit? And
the worst. There's nothing else on credit that you could do really right now in this moment that would be much worse, if any worse than, I mean, you're affecting 35% of your credit score because you're affecting your positive pay history there. You're affecting what the credit scoring algorithm really considers your most sacred account on credit. Credit, I mean, just mortgage wise, you've most likely disqualified yourself for 12 months from most programs. And so it really is not a good thing. Like, can we come back from it? Guys, we can come back from anything, right? Like, nothing is the kiss of death in credit. It might be right now, but we can come back from it. But with a mortgage score, like, again, if I added a late on my mortgage right now and my mid score is a 780, I can probably expect my scores to go down to the 700 range from one mortgage late, even though I have a bunch of other accounts that are all in good standing, right? Just because there's no such thing as a little late pay in general, but a mortgage is, you got to keep up on that thing. Keep up on that.
For sure. We'll talk about a little late pay in a minute after we answer mail colds. In your experience, which free credit score algorithm aligns close to the credit scores pulled by Matt the Mortgage Guy?
Honestly, none. I would be lying to you if I said, because you're going to end up with the same thing always. You just need to know that whatever scores you pull, just subtract 20, 30 points. If you subtract 20, 30 points as a general rule of thumb, you're going to usually be running close to your mortgage score. If you want to get your mortgage score, you can, we actually just, Matt, like a month ago, figured out a way for a client to it's not our company, it's a third-party company, it's a soft pull, doesn't count as a mortgage inquiry, doesn't give them any of their information, but we can give them a portal, it's a pass-through link, and they can pull for like $20 and get 2 out of the 3, but their mortgage scores. That's a little bit more complicated than it needs to be. If they want to go on to myfico.com, that's the closest you're going to get. I mean, you still probably need to deduct about 10 points, but that's also going to cost you $40. So there's just, if I could point you to somewhere that I was like, that one's only 5 points off of Matt, I promise I would, and I would use it all the time. It doesn't exist.
Yeah. I mean, I think the moral of the story is probably, do as much as you can to be as responsible as you can. And if you're in the ballpark 45, 60, 90 days from wanting to get a mortgage, reach out to a mortgage lender, go through the pre-approval process, get yourself pre-approved. And this is something that I harp on people quite a bit, Sam, is, even if you're 6 months out, I'm the one paying the $31 to pull your credit, and I don't mind it. I pull $100 a month, and I pay that bill with pride because I know I'm going to close, a certain amount of those loans, and it's all going to be a wash. But yeah, get your mortgage credit report pulled, because for a lot of people, there's stuff on there. You know this better than anybody, Sam, that like is just straight wrong, right? And so last thing you want to do is be in contract the first time your credit gets pulled, and then you realize like you've got a medical collection that's misreporting 40 points lower than you should be, and you're going to pay an extra quarter on your interest rate.
Yeah, it's silly. I mean, literally a $40 medical collection could cost you tens of thousands of dollars, because you're not going to stop. Like, let's be honest, if you would have gotten the best interest rate at a 680, and because that medical collection of 647 is pulled, the average consumer, 99 out of 100 people, are not saying, you know what, hold up, let's get this thing taken care of. They're saying, can you still qualify me? And then you're saying, well, yeah, but
my wife loves the granite countertops. We got to buy this house.
This is our forever home. I walked through it, and it felt right. And 4 houses from now, you'll realize that was cute, and I get it, but and that's another thing, Matt. Think of how many clients that we could give a shout to right now that it was like, hey, listen, I qualified you with a 620, a 640, a 660 in the past. Let's get a look at credit. Let's keep working on this, right? Because there's so many people that get through that and they go, I'm in my house, I'll deal with that later. And then later comes up so quickly,
Yeah,
so.
I mean, that's a really good point. There is probably, I don't even know how many, just so many clients in my database that 18, 19, 20 bought a house, and maybe they bought with an FHA loan, and they had a 4% interest rate, and they've got $280 in mortgage insurance. If they came to me now and said, hey, I've got this equity, I can remove my mortgage insurance. If they've still got a 640, it's not going to look nearly as good as if they've got a 720 now. It's like conventional loan, remove mortgage insurance, lower the rate, all that stuff. And, I've actually got some clients that, fit that, where it's like, man, we got to get your credit up, because getting your credit up is going to really save you a ton of money. And, there's nothing more important than your biggest bill that you have every month. And, people will spend 49 minutes on the phone with DirecTV trying to get free HBO or save $9. Like, spend a little bit of time, help your credit out and save yourself $400 a month on your mortgage. Then you can have Showtime and all the channels.
Yeah. And that's what I try to spice in some like good motivational stuff for my peeps. And it's like, I just want to tell them, like, look, it's not fun, and it might not be super simple right now seeming to you, but it's worth it. This is one of those things that it's just worth it to have good credit, because you know how you feel right now. You know that even if you're dealing with somebody like Matt, you're going like, Matt, can you please help me? Like, imagine the next time you go to work with Matt in a year or 2 years or 4 years, when you go, Matt, hey, Matt, dude,
pull my credit. So Let's see it.
Yeah, pull it right now. Give it to me. Give it 790. I knew it. What do you get me, Matt? And Matt goes, what do you want? What do you want? Like, I could get you this. I could get you that. Like, your credit's good, so we just got to look at income now. Like, what if credit was good, right? Like, what if that was the part that was always good? And it can be. You just got to teach yourself how to play the game. It's really not that tough once you realize all the little factors that go into it.
All the rules. Sam will show you all the rules. How is forbearance affecting scores these days?
Yeah. So what you're running into with forbearance is that in a lot of cases, that information is just not being reported to credit. So if you had like a nice long account that had been open a while, a lot of people are seeing that drop their credit scores, because that's basically extracted from the scoring algorithm while something's in forbearance. It's not helping you, it's not hurting you. And so people, because of that kind of byproduct of it, are like, oh, it's hurting me. It's like, it's not hurting you, it's just not helping you. So the inverse of helping you on credit is hurting you, right? And so that's what's happening. Now, what we're seeing most people able to cure when it comes for it, meaning, how does that loan restart? Are they able to make the payments, or is the company tacking them on the back? We're not seeing a big flood yet of people coming and going, forbearance just killed me. I couldn't make the payment and now I'm screwed. But I will say, like back in 2008, we didn't see 2008 really hit us in terms of people needing help until 2009, 2010. So the jury's still out a little bit on what has forbearance done. But for the most part, I would say it saved a whole bunch of people, and it's a short-term drop in credit score because of lack of positive data. But it looks like a lot of people are going to sneak back out the other side of this and be okay. But there's still a lot of people out of jobs right now, Matt. So it's tough to say.
Yeah, and I mean, I've had the opportunity to kind of talk with and counsel some clients of mine that, uncertainty or whatever the reason is, they took forbearance, and for some, it's a great opportunity. If you get 6 months off your mortgage, pay off some credit card debt, do some other things that, maybe it's savings, and maybe you want to build a nest egg, but maybe you've already got, an emergency fund, and you have the ability to pay off that $1,400 in credit card debt that you've had for the last 6 months, and it's kind of just stagnant,
Yeah.
And so
what did it do? Sorry. Like, for a mortgage lender though, Matt, what was that like when somebody was in forbearance? That was an automatic disapproval, correct?
Well, yeah, and it changed quite a bit. And as it was new to lenders, some lenders were doing it where they wanted you out of forbearance and paying 3 payments. Other lenders said, just come out of forbearance and you can immediately refinance. Just about all of them now just say, we want you to end forbearance, and we want a statement showing that there's no, past due payments, that you've, come out of forbearance, and then we'll be able to refinance you right away. So as long as somebody can qualify, and that's where I'm kind of running into issues, or at least counseling people. If you've lost your job, for sure, stay in forbearance. Don't come out, because you're not going to qualify for a refinance because you don't have the income to qualify for it. But if you have the income to qualify and there's a huge benefit to refinance, it's probably worthwhile to go ahead and call up your servicer, say, hey, listen, I've been in forbearance 2 months, but I want out. I'm going to start paying as of April 1st. Okay, out of forbearance, payment due April 1st, and then we'll refinance. And most of them have put like, it's your principal balance and then deferred amount. They've got 2 or 3 or 6 months of deferred. we pay both of those off, refinance you into a new mortgage, and you're off and running.
Perfect.
I think we touched on this, but if I have a 6-year-old charge-off account and pay it off, will it hurt my credit score?
Yeah, typically. Well, charge-offs are a mixed bag though, because like a collection, right? That's been sold to a third party. And so once something's sold to the third party, the balance to limit ratio doesn't factor into the credit score anymore. A charge-off is a collection action that's still held by the original creditor. If it's held by the original creditor and it's a revolving account or credit card, then it's still counting against you in the balance to limit ratio. So I would have to get a look at that credit report, because like, let's say that this charge off was the only representation of this person's credit on in that section, they would still be getting scored negatively based on the balance to limit like usage section, right? So if you go and you pay a collection off, you can get points from the 30% balance to limit ratio, and then you would lose points based on the updating of the date of last activity. So sometimes you just have to weigh those and see what's what. Now, with something 6 years old, I'm typically not going to have somebody pay that unless underwriting says so. But 6 years is right at that mark where it's like, you got to make a strategic decision. How big is it? Are they coming after you? You also have to know that that 6-year mark is, in a lot of cases, well, yeah, because in some states you're still, but when you get towards the end of that statute of limitations, it's not uncommon to see judgments being issued too. So you just got to be careful with debt that old, because if you start messing with it and it doesn't go your way, then it can spur them to go, oh my God, we're about to hit statute of limitations. We got to sue this person. So I wish I had a one size fits all answer for you, other than sometimes you want to pay it off. And if you do pay it off, get a settlement or pay for deletion. And in some cases, you leave that thing alone and you let sleeping dogs lie, and it's going to fall off the credit. You know, if you're at 6 years and 9 months and 3 months, that thing has to pop off. So
the best one size fits all answer is Sam and his team do free consults. So if you don't want to be guessing and you want a free consult, then, you know, get with Sam and his team, MyCreditGuy.com, and you know, have them review it, because that's just the same verbiage that comes out of your mouth sounds like me when I'm talking to a mortgage prospect. The more I know, the more I can see and dig into your scenario, how much down you're putting, what your credit score is, you know, how much reserve funds you have in your bank, and what you're looking to do, all that stuff. The more information I have, the more better I can diagnose. And right. I, like you, Sam, like to use analogies, and maybe they only make sense to us. But when somebody calls me and they want me to diagnose what's wrong with their vehicle and it's making this funny noise, drive it in. Let me lift up the hood and let me look inside. I'll be a much better mechanic once I can get the hood up and look in it, versus you telling me it's making a pinging noise in my driveway. Well, how much of a pinging noise and what's the tone? So, right. Same stuff with credit and with mortgage. The more we know, there's 565 million scenarios. So, you know, we've got to pin down exactly your specific scenario and how we can help you the most. When purchasing a vehicle using financing from the manufacturer, how can we make sure the dealership isn't bumping the rate? Magic phrases to ask.
Jeez, I hate that experience so much that I bought my last 2 vehicles on vroom.com just because I can't do it anymore. I'm sorry, any car guys out there, you hate me right now, but it just gives you an opportunity to create a different experience, because I don't know what to tell you on that, man. What I usually do is I check with a local bank first, and I say, what's the going rate? Am I pre-approved? Anytime that you can go into that situation pre-approved, it gives you a lot of power in a couple different ways. First of all, you're going to get the rate that you got, or they have to try to beat it. And so that way, you know, you're going to get the best rate, but it also lets them know, like, you can use it as a tool to go in and go, look, I'm approved for 30 grand. I want that car. If I don't get that car here, and they're like, well, with all the bullshit that we want to put on it, it's 37,000. You're like, that's cool. I want it for 30. That's what I am approved for. I'm approved for already with my local bank. I need that out the door, or else. So it gives you leverage a couple different ways, but that's what I do, at least, is I go to my local trusted bank first, have them approve me for an auto loan, And then after that, I take that to the finance people that are trying to sell me the car and go, look, I'm not sitting in your office for 4 hours. They'll go, no, it's only going to be 15 minutes. And you say, no, it's not, because it's never been 15 minutes and you're a liar and I don't want clear coat. And
what about the warranty, Sam? My finance manager, he's going to approve me for this warranty. It's usually $3,600, but for you today, Sam, $1,900 out the door.
Yeah. And you know what? Here's the deal. I don't push this usually, but you got the kids. And if the kids spill it on that and it has to come back in, it's a full cleaning. This would be free. This will be covered. And then the last one, I got so far down that the guy literally said to me, he goes, I got to tell you, this is how I get paid. Like he said, he goes, I'll tell you, if I don't sell you a warranty, I don't make very much on this car. I was like, fine.
Yeah. For you, you're a nice guy.
Yeah. I was like, just get me out of here, please. But yeah.
It's interesting. It'll be interesting to see what happens. I mean, so many different industries are changing, and like there's shift in all these car companies that just change the car buying experience. I mean, CarMax, me and my wife sold a car a couple of years ago, and that was by far like the easiest, smoothest experience. We go in there, and it's like they do a 30, second inspection. All right, we'll give you $5,800. All right, we'll take it. Write us. Just print out a cashier's check. See you later. Much better than listing it on,
having everybody show up to your driveway and you're like, now listen, I'm not taking less than 58. And they show up and they're like,
I got 4,200 in my pocket.
So that's great. 42 would be great, dude. I get people that are like, would you take 25? No. So,
I've asked dealers if that's the buy rate or sell rate.
Yeah. There's a difference.
They get a little spread, right?
Yeah, I just tell them I from the minute I start talking with the car guys, if I talk with them, I tell them, I go, look, I'm a sales guy. I'm going to tell you the truth. You might not like dealing with me. I'm going to be cut and dry about this. Don't take anything offensively. And then they seem to not do any of that. I'm sure there's great car people out there too.
Yeah, I know. So I just know great car guys. So I apologize. There's some good car guys, but for the purposes of our conversation and mortgage, I'll let everybody know the good news. In mortgage, no matter what your rate is, no matter what program you get placed into, mortgage brokers get paid the same flat fee based on the loan amount. So our loyalty is always to provide the client with the best possible loan, because no matter which loan it is, get paid the same amount. And if you're satisfied and happy with your loan, you refer your neighbor, your cousin, your best friend. So in mortgage, there's not going to be any warranties sold at the end of it, which, maybe we should start that.
Home warranties.
Yeah. I mean, that's a whole other thing. I better talk about home warranties.
What people don't realize, and I know that, you have to educate them in the proper way about this, but a lot of people are paying their own warranty on themselves with PMI when they have higher or lower credit scores. They don't realize that you're literally paying insurance on yourself for the lender because you're a higher risk, and that doesn't go towards your principal. It doesn't go towards your balance. So just by getting a higher credit score, you can just be maximizing your equity that you're putting into your livable piggy bank. Right.
Yeah. And that's the thing about mortgage insurance nowadays. So such a huge percentage are conventional loans nowadays. And with the market as hot as it is, it's getting harder for FHA financing to get accepted. And this is something that, I'm sorry if FHA is the only loan that you qualify for. I don't make the rules. The market kind of dictates what loans are getting accepted. But, conventional, if you put 5% down, 10% down, your mortgage insurance is based on your credit score. And I've told people the coolest part is over the last 3 or 4 years, mortgage insurance rates have come down so dramatically. If you've got a 780 credit score, you can put 5% down and have these little itsy bitsy $57 a month, $65 a month in mortgage insurance.
Yep.
You've got a 660 on that same loan and you're paying $285 a month or $310 a month. And so, like you said, that's insurance you're paying to the lender saying, hey, listen, I don't have that good of a history, so I'm more risk to you, which, makes sense. And I'm going to pay for that. I'm going to pay for it, $3,000 a year worth of it until it falls off.
Yeah. Well, it's just like somebody, you got to remember, they're putting up the money. They technically, and I know nobody likes to hear this. I don't like to hear it as I sit in my house, but at the end of the day, the bank has claim to this house just as much as I do at this point. Right. And so it's like it's just like when you go to rent a car and they say, well, what's your driving history like? And you go, I get in accidents. That's what I do. I speed and I get in accidents. They're like, you have got to give us a huge deposit on yourself.
Right.
I mean, you got to be good. You got to be good.
That's a good analogy. Is 740 the magic threshold for best mortgage rates? Most lenders, that is their top bucket, 740 and above. And so that's why it's funny when it's, husband and wife on there, and the husband is 786 and the wife's 792. And she's like, look at me, I'm better. And I'm like, anything above 740, you're going to get, top tier mortgage rates. So you guys are both doing good, but that's something that is literally every time there's a husband and wife and they both have good credit, it's like a challenge for them.
We do it all the time. Me and Trish, because we're credit people too, So I got her for the first time ever. This last time I had pulled ahead of her by like 10 points, but it's because she had a company card that reports to her credit, and so do I, and I paid mine off before hers.
Oh, good stuff. I've got one more question I wrote down that was from a past client of mine that's got a 5-year-old BK, and they want to know, I think their credit's probably low 7s. They want to know if that's still hurting them and what they can do to kind of speed up the process of having that thing disintegrate.
Yeah, you can always challenge a public record, and a lot of times when they get to that, technically a Chapter 7 is going to stay on credit up to 10 years. Chapter 13 stays on for 7 years. Chapter 13 is when you restructure and pay off the debt. A Chapter 7 is a wipeout of all unsecured debts that aren't government backed, just so that we're all on the same page. You can dispute the judgment itself. We don't typically, just because it's accurate, and we want an accurate depiction of who the client is. Plus not the judgment, the public record itself really doesn't hold that many points. It's all the individual items that were included in the BK that if you go down the credit report, it'll say like this item, $0 out, included in Chapter 7 BK. This item, $0 balance, included in Chapter 7. What you want to look at is what's called the MOP rating, method or manner of payment rating. And a lot of times those are still going to be coded as 9s, which is collection, charge off, profit and loss. And they should be 7s, which is bankruptcy. If they're still 9s, they're still having a drastic impact on the credit and they need to be removed or updated. As a good rule of thumb after a BK, it's a good idea just to go through and hit all those negatives and make sure that they're updated correctly. If somebody's up in the 700s, there's a good chance that a lot of that has already fallen off the credit report or isn't impacting. And so no, the public record itself, I would just leave that thing alone. The other thing that I'll tell a client, and not that this past client was going to do this, but when and if we are able to get a bankruptcy removed, you're gonna have to answer on the next loan application, do you have a bankruptcy in the last 7 years? And a lot of times when it's not reporting on credit, you're tempted to say no, which is mortgage fraud. And so we like the credit report to be nice and accurate. If that bankruptcy was accurate, let's leave it on there. It's not hurting anything really. And we just want to address those individual items that were included in the bankruptcy because there are a lot of points there.
Right. Yeah. I think it goes both ways. Sometimes there's derogatory stuff from the past where, a property report shows, hey, you got a short sale that was 5 years ago, but it's for whatever reason, it's not on the credit report.
Right.
I'm a math nerd. So you might know this number. I know I've heard stats about how many credit reports are inaccurate or like percentage of,
The last one I heard was 79% of the American public's credit report is inaccurate. Of those inaccuracies, 25% of those, basically 80%, are serious enough that it could stop somebody from financing. But that's a pretty, I guess, relative thing to say, because who are you to say that, that the inaccuracy that dropped me down to a 715 from a 740 didn't disqualify me from something way better, right? And so I see, if I went through everybody's credit report with them, I would guess 10 in a room. I would bet that there's 80%, maybe more, that I can find at least something wrong on that credit report. But yeah, sometimes you're being nitpicky and it's like, well, it's an old address and technically, you didn't live there. You just got mail there for 2 months, that sort of a thing. So
right.
So yeah.
Cool.
Yep.
What are these guys talking about? Responded and showed me the rate sheet on their screen. Not sure. They're talking about the car lender showing the rate sheet on the screen. I don't know if they went that far, Alice, to show you a fake screen.
No, I'll relax,
Yeah.
man. So some people are trying. If you put the guy in that kind of a corner, you're probably good. Plus, anybody that would be thinking about doing sketchy is smelling that you got your stuff together, and they would have run away a long time ago.
Right? Yeah. When I show somebody our rate sheet, I'm not going to go through the trouble of photoshopping or anything. It's just like, oh, you know how mortgage rates work, and you want to see the whole rate sheet from 2% all the way to 3.25%. Here it is, and have at whatever you're willing to buy down in points. You're in Florida, right?
I am right now. Yep, I'm in Fort Myers.
All right. I don't want to keep you up past your bedtime, man. If you want to tap out, you let me know. I
got a couple more minutes if you got another question or two.
Yeah, I mean, I've got some that I had written down from past clients. I'm searching through here to see if I missed anybody. Credit is muy importante when it comes to what I'm trying to do and serve people in the mortgage space. If I don't find any more questions, I might just wrap it up. But I appreciate your time, and I appreciate just talking through some of this stuff, because I think both of us are aligned, and we're just trying to help educate folks. And like you said, and like I'll say, it's not like I'm just trying to get somebody into a house as soon as possible. Like let's talk about your scenario. Let's get you ready, and let's see what we can do for, thank you, Mail Cold. Appreciate that.
Thank you.
And so, yeah, a piece of what I do is definitely the credit stuff. I appreciate guys like you that are putting out good content. Do you have what's your preferred method? We've got MyCreditGuy.com. I know you got a YouTube channel out there that's got some good credit tips on it. What's another way to get a hold of you if anybody has any credit questions or, thinking about credit repair?
Yeah, I mean, the best way, honestly, Matt, is if they're watching it from you, to get a hold of you and to discuss their mortgage. Even if you're thinking about getting a mortgage in 4 years and it's not enough, if you just have that discussion with Matt first, it's great. But you can go to MyCreditGuy.com. Like you said, our YouTube channel, and you can just search My Credit Guy, look for the check mark is what you'll find, and there's stuff on there. But my email is sam@mycreditguy.com as well. And you can always just send a question there. I will admit that in the next 2 weeks, it'll be my staff, my team that most likely gets back to you from my email. But other than that, I'm usually on that thing, and you'll get a response same day. Almost always, if you email us after 6 o'clock at night, wait until the next morning, but we'll get right back to you because we know that you're probably anxious about this.
Cool. I'm jealous, man. You going on vacation?
We snagged another little piggy bank down here, and just when COVID hit, I said, what better investment or savings tool would there be than somewhere that has a backyard with some water in it, and I had to get somewhere that I could go fishing more often.
Nice.
Yeah.
Cool. Good deal. Well, thanks for joining us, man. I appreciate you, and good discussion. If anybody has any questions for me, Matt@MattTheMortgageGuy.com, shoot me the email, and if it's credit related, I'll refer you to the right place, and I'll forward it on to Sam. Thanks again, Sam, for joining. I appreciate it, brother.
Thanks, Matt.